Hello, my name is Lorenzo Stallion. This is my finance analysis for my Finance 381 class. And today I'm going to look at three companies and tell you which company I would loan a short-term loan to, a long-term loan to, and buy 50% of their company. And three companies I chose were Whole Food Market, Costco, and Exxon. To start off, I look at the cash to current and quick ratio. The cash ratio is the cash over current liability, which tells us how much cash the company has over its current liability. The current ratio is current assets over current liability, which tells us if they can pay their debt. And the quick ratio is the current assets minus inventory over current liability, which tells us if they can meet their short-term liability. I collected data from 2010 to 2014, but I'm going to focus on 2012 to 2014. Okay, for Whole Food Market, which is my first company, the cash ratio in 2012 was 1.25, 2013 0.94, and 2014 was 0.59. As you see in this chart, each year the cash ratio, it was high, but then it decreased in 2013 and 2014 decreased even more. Also with the current and quick ratio, it was fairly high, but they also decreased each year and decreased even more the following year. And keeping in mind that you want the current cash and quick ratio to be higher. For Costco, as you see 2012, the cash was 0.40, the current was 1.10, and the quick was 0.48. And according to this graph, you see that 2012 they was low, but they increased gradually in 2013 and increased even more in 2014, which is a good look if you want to loan them a short-term loan. And for Exxon, the cash ratio is 0.15 2012, the current ratio is 1.01, and the quick ratio is 0.59. As you see, the cash, current, and quick, they all decreased in 2013. In 2014, the current and the cash increased and the quick decreased. And keeping in mind that you want the cash, current, and quick to be fairly high. And which company I would loan a short-term loan to? I chose Costco. The reason I chose Costco is because in 2012, each of these ratios was low, but as you see, they gradually increased in 2013 and 2014, they increased even more. And each of the other companies decreased in each of these categories. For my long-term loan, I look at the equity multiplier and the time which is earned. The equity multiplier measures the leverage the company has, and the time which is earned tells us if the company has the ability to pay off their debt. And for Whole Food Market, the equity multiplier was 1.41. In 2013, it stayed steady, it was constant, and it remained 1.41. In 2014, it increased to 1.47. And keeping in mind that you want the equity multipliers to be low, and you want the time interest earned to be high. And the time interest earned for 2012 was 2,100.30, which is fairly high. They must have had a good year that year. And in 2013, 2014, they didn't have no time interest earned, which kind of wonders what happened in 2013 and 2014. For Costco, in 2012, equity multiplier was 2.21, and each year it increased. It didn't increase a lot, but it increased. And time is earned 2012 was 29.04. It increased in 2013, which is a good thing. Increased to 30.84, and it decreased in 14 to 28.50. And for ExxonMobil, the equity multiplier was 2.08 2012, and 13 it went down to 2.00, and in 14 it remained, it was constant at 2.00, which you want that to be low. So that it's looking fairly good. In 2012, the time it's earned was 152.54, and it increased in 2013 to 4,477.89, which is a good thing. They must have had a good year in all other years. In 2014, it decreased to 119.17, which is fairly still good. And which company I would loan a long-term loan to? Exxon. The reason I chose Exxon because the equity multiplier, it was at a steady rate. It decreased in 2013, and it remained 2.00 in 2014, and the equity and the time interest earned was 152.54, and increased tremendously in 2013, but it decreased in 2014, which is still fairly good. And which comes out by 50% of? I'm going to look at the return on asset, return on equity, and the profit margin, and the return on asset. But you want each of these to be fairly high. But you also have to keep in mind the equity multiplier, the price to earning. The return on asset, it tells you that how management uses their asset efficiently. Return on equity is the ability the firm has to generate money from a shareholder. The equity multiplier, it measures the leverage, as we seen in the previous slide. The price to earning, it defines market per share price. The profit margin, it tells us the amount of net income earned with each dollar. And the total asset turnover tells us how the company generates assets. The whole food market, RA 2012 was 9.71, and it increased. 2013 and 14 it decreased. The RE was 13.71, and each year it increased, which is a good thing because you want the RA, the RE, the profit margin, and the total asset turnover to be fairly high. For Costco, the RA 2012 was 6.34. It increased 2013 to 7.10, and it decreased in 2014 to 6.50. But the RE was 14.03 in 2012, but it increased each year, increased even more in 2014. For ExxonMobil, the return on assets was 13.50, and it decreased each year. 2013 was 9.57, and 2014 was 9.34. The return on assets, they did good in 2012, 28.03. In 2013, it decreased to 19.7, and 14, it decreased even more. And the profit margin was 10.71, 2012. It decreased in 13 to 8.35, and it decreased in 2014 to 8.92. Which I would buy 50% of. I chose Whole Foods. The reason I chose Whole Foods is because the return on asset, return on equity, and the profit margin, they all increase each year. And the other two companies both decrease. Thank you, my name is Lorenzo Stallion, and y'all have a nice day.